If physical silver dealers repriced as much as 50% overnight, that can be a system stress signal, not proof of a shortage but a warning light. And the question behind today's title is simple. Why would dealers move first, before spot even updates? Because if the physical market is pricing availability risk, the next test is what happens when the paper market has to reconcile with that gap. So here's the framework. I'm not here to hype you, and I'm definitely not here to give you personal financial advice. I'm here to do what most people don't do when a commodity does something weird. Slow down, separate signals from stories, and map the mechanism. And I'm going to keep my language disciplined. Confirmed when it's confirmed, likely when it's likely, and unverified when it needs verification. No shortcuts, full stop. On my screen I've got two panels. On the left is the paper reference price, spot or futures, the number that gets quoted in headlines. Lead time is the weight. Those two terms are often more honest than a chart, because they describe what the supply chain can actually deliver. And I'm calling this illustrative on purpose. I'm not claiming a specific dealer's private quote. I'm showing you the structure of the gap. Because once you understand the structure, you can check it yourself across multiple sellers, over multiple days without needing to trust me. Now, what do we actually have in hand? The strongest thing we have right now is an early signal. Reports that some dealers moved physical asking prices sharply relative to the last visible paper reference. Some chatter puts that move as high as roughly 50%. That is not a database. That's not a confirmed industry print. It's an early sign, and it becomes meaningful only if it persists and lines up with other indicators. The second piece is a very normal, very boring explanation that people ignore: replacement cost. Dealers are inventory businesses. If they sell you an ounce today, they immediately inherit a question. Can they replace it next week, and at what price? If the answer is, I'm not sure, the rational move is to widen spreads, raise premiums, limit quantities, or even go no quote. That's not drama. That's risk management. Here's the part that makes this feel overnight. Most physical pricing isn't a brand new price discovery process every minute. It's a formula, benchmark plus premium. The benchmark can stall or trade thin in off hours. The premium doesn't. The premium is where fabrication costs, sourcing terms, shipping, inventory risk, and replacement uncertainty get priced in. So when something changes inside the supply chain, availability, lead times, or who is willing to sell, dealers can move the premium hard, even while the benchmark line looks unchanged for a few hours. That's how you can wake up to a premium shock without seeing the paper number move. And if you've never watched this happen before, it feels unfair. It isn't. It's the market rationing immediacy. If metal is easy to restock, premiums stay modest. If metal is hard to restock, the premium is the pressure valve. It's also the first place you see stress, because it's the first place the real-world constraint shows up. Here's another way to think about it. Paper can trade on expectations. Physical trades on logistics. A contract can change hands 1,000 times without a single bar moving. But the moment somebody needs delivery, the chain has to perform. Dealers live in that moment. That's why their behavior can be a leading indicator, again, not proof of a shortage, but a clue about conditions. Normally, gaps like this don't stay wide. In a healthy system, arbitrage and restocking close the distance. Dealers buy metal, hedge their exposure, refill shelves, and premiums mean revert. So I'm not going to tell you a 50% move proves a shortage. What it can prove is much more specific. The businesses closest to physical supply believe their replacement risk changed faster than the paper benchmark was moving. And that's the core of the title. Dealers don't reprice because they feel like it. They reprice because their inputs changed: availability, delivery timing, and replacement risk. Those inputs can change faster than the paper reference price updates, especially in thin liquidity windows, holidays, or off hours. Now, you've probably heard a bunch of explanations for why this is happening. Some of them might be right. Some of them might be wildly wrong. A lot of the more specific claims about exact policy thresholds, exact approval timelines, exact shares of refining capacity, exact export flows, are unverified in the material we're working from. So I'm not going to build this episode on a single geopolitical narrative. If those details get confirmed by reliable sources later, great, we can update. What I will say is this: Even without naming a single country or a single rule, it's not hard to imagine choke points in the middle of the supply chain. Mining is one step. Refining is another. Distribution and wholesale is another. By the time metal reaches a dealer's shelf, it's passed through a chain of contracts and timing assumptions. A disruption anywhere in that chain doesn't have to stop the world to change replacement risk. It only has to make the next shipment uncertain. And here's why the mechanism matters. The paper market is where a reference price is discovered. It's liquid, it's fast, and it trades in abstractions, contracts, not bars. The physical market is where real metal changes hands, where delivery promises either get met or get delayed, and where the cost of being wrong is immediate. When physical reprices ahead of paper, it can be the market's way of saying, the benchmark number is stale for the real world, at least for now. So I want you to hold one thought as we go forward. A screen price can be right as a benchmark and still be wrong for someone who needs deliverable metal on a deadline. Deliverable just means metal that can actually be sourced and shipped on normal terms. That's why premiums and lead times matter. That's why availability is not the same thing as price. And that's why a sudden dealer repricing can be a warning light, even if it turns out to be temporary. Here's the key insight I want to plant before we go any further. The price you see on a screen isn't always the price you can actually source metal for, especially overnight. Dealers are telling you that implicitly when they widen the spread between paper and physical. Now, before we run with any narrative, we have to separate what's observable from what's still unverified. Let's stack the signals, premium behavior, lead times, and the early plumbing indicators that tell you whether this is real stress or just noise. When dealers reprice that fast, it usually means one thing. They believe replacement just got harder, slower, or more expensive. So let's talk signals, what's being reported, what you can verify, and what it implies if it persists. If you only remember one sentence from the last section, make it this: dealers don't live in the spot chart. They live in the moment they have to restock. So here's how I want to approach this, like an investigation, not a rumor mill. On my screen, I've got two checklists. One is physical stress indicators, the things you can observe in the real market without needing insider access. The other is paper plumbing indicators, the things that tend to move later if this turns into a true system story. Let's start with the physical side because that's what your title is really about. First, the premium. In plain English, premium is the extra you pay above the benchmark to get real metal now. Premiums exist all the time, but the pattern matters more than the number. If you see the premium jump at one seller for one afternoon, that can be noise. If you see it stay elevated across multiple sellers for multiple days, that's a different signal. That's the market charging you for immediacy. That's how you turn noise into a signal you can test week to week. Second, lead times. Lead time is just the wait between I place an order and it shows up. In normal conditions, lead times are boring. In stressed conditions, lead times become a headline all by themselves. If you hear 8 weeks, then 12, then 20, that's not a chart pattern. That's the supply chain telling you it's tight. Third, quoting behavior. When availability gets uncertain, dealers and wholesalers don't always just raise prices. Sometimes they change the rules. Smaller maximum order sizes, delayed shipping windows, call for pricing, or a flat-out no quote. That's not a moral judgment. It's a business protecting itself from selling inventory it can't replace. Fourth, the replacement narrative itself. The reports we're working from keep circling back to the same idea, replacement cost. And that's the heart of the overnight part. A dealer can sell at today's price, but if they believe tomorrow's restock is higher or delayed, they have a choice. Reprice now, or risk selling out at a number that turns into a loss the moment they restock. Before we go any further, let me give you a verification method that doesn't require special access. Don't anchor on one screenshot or one product. Premiums can jump for reasons that have nothing to do with a global shortage. A mint bottleneck, a fabrication backlog, a dealer running low on one item, even a holiday disruption. So the clean check is breadth and persistence. Look across multiple sellers and multiple common products. If higher premiums show up across the board and stay there for several trading days, not just an afternoon, That's the difference between a one-off quote and a genuine signal. Also watch quoting behavior, not just the sticker price. In calm markets, dealers quote confidently and spreads stay relatively tight because they can replace inventory and hedge exposure. In stressed markets, you'll see more friction. Smaller maximum order sizes, call for pricing, delayed shipping windows, or a flat, no quote. Those are defensive moves when replacement feels uncertain. And remember, there are layers inside silver. Retail coins and small bars include fabrication and distribution, so their premiums can widen even if wholesale conditions are only mildly tight. Industrial buyers care about timing, purity, and delivery terms. They don't have the luxury of waiting for a retail backlog to clear. The point is not to guess which layer is stressed from a headline. The point is to watch whether the same direction shows up in more than one layer. That's why I keep a second checklist for paper market confirmation. In plain English, spreads are the price difference between contracts that deliver sooner and contracts that deliver later. If the near term gets unusually expensive, it can be the market hinting that deliverable supply is tighter right now. And implied volatility, or 4, is basically the price of uncertainty. If this turns into a broader stress case, spreads and 4 are often where it begins to show up without proving the cause. Now some people want to jump from those signals straight into a single cause. You've probably heard very specific claims, policy thresholds, approval timelines, percentages of global refining, hard numbers on export flows. In the material we have, those details are not confirmed. So I'm treating them as unverified until there's reliable second source verification. But here's the key point. You don't need a fully confirmed geopolitical story to understand why the physical market might react. Physical stress can come from any choke point in the chain: refining capacity, shipping constraints, credit terms, even simple unwillingness to commit to delivery at fixed prices when conditions are changing. If the next shipment becomes uncertain, premiums and lead times are where that uncertainty gets priced. Now let's connect this to the paper side without jumping ahead. Spot and futures are reference prices. They're benchmarks. They're incredibly useful for hedging and for headlines, but they are not the same thing as deliverable metal on my timetable. When physical prices gap away from the benchmark, one of two things usually happens. Either the physical tightness eases and premiums fall back, or the benchmark catches up once broader liquidity returns and the market digests the new information. This is where the systemic part starts to peek through. If you're a manufacturer, you can't solve a supply problem by owning a chart. You solve it by securing metal on terms you can count on. If you're a dealer, you can't pay your bills in spot. You pay them in replacement inventory. And if enough real-world buyers start competing for the same limited deliverable supply, the benchmark can stop being the thing that matters day to day. The terms, premium and lead time become the story. So why did dealers reprice overnight? Because replacement risk can change overnight. Dealers protect inventory first, and spot catches up second. If you want a clean way to verify whether this is fading or building, don't obsess over one screenshot. Track 3 behaviors over a few days. Do premiums stay elevated across multiple sellers? Do lead times keep stretching? And do no-quote moments become more common? If those cool off, the story de-escalates. If they stack, we move to the next question. How does the paper market respond when it has to reconcile with what the physical market is already pricing? Now we get to the trigger, when the paper market has to confront that physical gap. And before we run scenarios, there's one mechanism detail that changes everything. Inventory isn't the same as availability. Here's the trigger. When liquidity returns and paper trading resumes, price discovery gets tested against deliverability. If the physical gap is real and persistent, paper can't ignore it forever. It either reprices or the stress eases. What I want to do in this section is not predict a price. It's to map the plumbing so you can watch the system behave in real time without turning a quote into a story. On my screen, I'm laying out a simple gap map. Left side, the paper reference price, spot or futures, the benchmark number. Right side, the physical asking price, what dealers and wholesalers are willing to quote, including the premium and the delivery terms. You already have the anchor from the last section, so I'm not going to repeat it. I'm going to push the story forward. What has to happen next? Mechanically, if physical conditions stay tight while paper markets reopen. Start with the cleanest outcome. The gap closes the normal way. Paper trading returns, the reference price reprices, physical premiums cool, restocking becomes easier, and everything converges. That's not a systemic crisis. That's the system doing its job, price discovery catching up to real-world conditions. The reason people get nervous is the second outcome. The gap doesn't close quickly because the constraint isn't sentiment. It's deliverability. Deliverability is a logistical and contractual problem, not a chart problem. It's the difference between I can buy exposure and I can secure metal on terms I can actually count on. Here's the conditional chain, and I'm going to keep it disciplined. If physical premiums stay elevated across multiple sellers, dealers respond defensively. They raise asking prices, tighten quantity limits, widen spreads, or go no-quote. Not because they want to gouge, but because they don't want to sell inventory they can't replace on normal terms. In a stressed market, protecting inventory is not optional. It's survival. If industrial buyers face deadlines, they don't care what spot was last Tuesday. They care whether metal can arrive on schedule, in the form and purity they actually use. That can concentrate demand into a smaller pool of deliverable supply outside whichever channel is constrained. And when multiple buyers hit the same narrow pool at the same time, the rationing mechanism isn't subtle. It's premium and time. Then paper markets re-enter the story. When liquidity returns, the benchmark becomes the meeting place for hedging and risk transfer. That doesn't mean paper creates metal. It means paper reflects how aggressively participants are trying to secure exposure, hedge future needs, or protect themselves from replacement risk. But we need a method that doesn't require reading minds. That's where the confirmation layer comes in. You watch the public stress gauges, what I call the system's vital signs. Spreads. In plain English, that's the price difference between near-dated delivery and later delivery. If the near term gets unusually expensive relative to later months, it can be a sign the market is pricing tightness now, not later. It's not proof of a shortage. It's a clue about urgency. Implied volatility, or 4. That's basically the market's price of uncertainty. If uncertainty spikes, 4 rises. That doesn't prove a shortage. It proves the market thinks the range of outcomes just widened, meaning participants are paying more to protect themselves against surprises. Deliverable proxies. You're not looking for a magic number. You're watching direction. Are deliverable categories tightening, staying flat, or loosening as prices move? Inventory is a headline. Deliverable is a condition. Now, here's the twist that changes how you interpret the whole situation. Inventory isn't the same as availability. A warehouse can hold metal that is fully owned, allocated, or committed. Allocated in plain English means it's already assigned to somebody's account. It exists, but it isn't for sale unless that owner chooses to sell. And even when metal is in a vault, mobilizing it can involve friction. Paperwork, transport, insurance, financing, assay requirements, and the willingness of whoever controls it to release it on your timeline. In other words, the metal may be there, but not available to you today at this price on this timeline. This is why big inventory numbers can coexist with a high delivery premium. The market isn't only pricing how much metal exists. It's pricing how much metal is willing and able to move right now into the hands that need it. It also explains why some easy fixes don't fix things quickly. People will say, well, if physical is high and paper is lower, arbitrage should close the gap. Sometimes it does. But arbitrage depends on execution. Sourcing, financing, timing, and the ability to convert a paper exposure into a physical delivery without getting stuck in the middle. If the stress point is in the middle of the chain, refining capacity, export terms, wholesale allocation, or simply unwillingness to commit to delivery, then arbitrage can fail, at least temporarily. And keep an eye on where the stress shows up inside the paper system. Exchanges and clearing houses are the plumbing that keeps trades settled. In calm markets, nobody notices them. In stressed markets, their job is to make sure everyone can perform, meaning they can change margin requirements, tighten rules, or demand more collateral. I'm not claiming any rule change is happening here. I'm saying that's one of the levers the system uses when uncertainty jumps. Bullion banks and big market makers sit in the middle, too. They provide liquidity, hedge flows, and warehouse risk. When conditions are stable, they quote tight. When conditions feel unstable, they quote wider, reduce size, or step back. That behavior can make price moves look violent, even if the underlying story is simply that fewer participants are willing to be the other side of the trade. One more plain English definition you'll hear: registered or deliverable categories. Don't get lost in the jargon. The practical question is, what metal is actually eligible and willing to be delivered through the system under normal terms? Even if a vault contains a lot of silver, only a subset may be immediately deliverable without somebody choosing to release it or without a chain of paperwork and financing. Now add one more layer of plumbing, again conditional. If volatility rises, margin requirements can rise. If margins rise, leveraged participants may need to reduce risk. That can amplify moves in either direction because it forces action. I'm not saying that's happening. I'm saying that's the pathway that turns supply chain stress into market stress. Higher uncertainty leads to higher collateral demands, which can change behavior fast. So what do you do with this in real time? You watch whether the physical indicators from the last section persist, and whether the confirmation layer starts to align. If premiums compress and lead times improve as paper reprices, that's convergence. If premiums stay elevated, no-quote behavior spreads, and paper stress gauges tighten, that's the system telling you the constraint is still there. So what happens next depends on whether this resolves as a normal repricing or escalates into broader system stress. Let's lay out 3 scenarios, with clear triggers and falsifiers, and a watch list you can track without trusting anyone's narrative. Let's end this the responsible way. Not with price targets, with conditions and checkable signals. If this was just an overnight anomaly, the indicators cool off. If it's systemic stress, they stack. So here's how I want to close this, with a decision framework you can run yourself. Not vibes, not headlines, conditions, signals, and falsifiers, because the fastest way to get misled in commodities is to fall in love with one story. We started with a basic question: why would dealers move first? And the clean answer hasn't changed. Dealers price replacement risk. If they think restocking just got harder, slower, or more expensive, they move the premium first, long before your benchmark chart has time to catch up. Now we move from explanation to diagnosis. On my screen I've got a simple matrix, 3 scenarios down the left and 4 columns across. 1, the condition that triggers it. 2, what you would expect to see. 3, what would falsify it, and for what to watch first. You don't need to believe a narrative. You just watch whether the signals stack. Scenario 1 is the base case. Normalization. The overnight premium shock fades. Dealers keep quoting normally. Order limits ease. Lead times compress instead of extending. In this outcome, the physical paper gap closes in the boring way. Either the benchmark reprices and premiums cool, or premiums cool and the benchmark stops looking stale. The falsifier is straightforward. If premiums stay elevated across multiple sellers for multiple days and lead times don't improve, normalization isn't happening yet. Scenario 2 is the stress case. Persistent tightness plus a volatility feedback loop. Here the physical indicators don't cool off. Premiums remain elevated across multiple sellers. Lead times stay long. Call for pricing, quantity limits, or delayed shipping windows become more common. Then you look for alignment in the plumbing. Near-term conditions price tighter than later months, implied volatility stays bid, and liquidity feels thinner, meaning it takes less order flow to move the benchmark. None of that proves a cause. It proves urgency and uncertainty are being repriced. In a stress case, pay attention to how the middlemen behave. Market makers and large intermediaries provide liquidity when conditions feel stable. When conditions feel unstable, they widen spreads, reduce size, or step back. That's when moves start looking violent, even if the underlying issue is simply that fewer participants are willing to warehouse risk. Another tell is whether people begin talking less about price and more about terms. Delivery windows, quote validity, minimum sizes, and whether a quote is actually firm or just a placeholder. What falsifies the stress case? You'd expect to see physical conditions ease. Premiums compress across multiple sellers, lead times shorten, and the no-quote behavior fades. In other words, the delivery premium disappears. If the market stops charging you for now, it's a sign the constraint is loosening. If spreads and floor calm down while premiums fall, that's unclogging in real time. Scenario 3 is the break case, and this is a high bar. This is not silver rallied. This is a confidence event around delivery or settlement mechanics. To even discuss it responsibly, you'd need verified signs. Formal changes in rules or margin that are explicitly tied to stress, credible and repeated reports of performance problems, or clear shifts in terms that suggest the system is rationing delivery rather than simply repricing risk. I'm not claiming that's happening. I'm saying you don't cross into that conclusion without hard evidence. And remember the twist from the last section. Inventory isn't the same as availability. Big stockpile numbers can coexist with tight conditions if most of that metal is allocated, committed, or simply not willing to move on your timeline. That's why a delivery premium can persist even when somebody points to a large number on a spreadsheet. Now let's turn that into a watch list you can actually use. Tier 1 is the street-level stuff, the physical indicators closest to real metal. First, the premium trend across multiple sellers, measured by breadth and persistence, not one screenshot. Second, lead times, are they stretching or compressing week to week? Third, quoting behavior. Do you see more limits, more delays, more no-quote moments? Fourth, a deliverability proxy. Don't worship a single number. Watch direction and consistency in whatever public proxy you use. Tier 2 is the confirmation layer. This is where paper market plumbing tends to echo physical stress if the stress is real. Near-dated tightness proxies, implied volatility and skew, shifts in open interest and volume, and any verified notices about margin, clearing, or contract terms. In calm markets, these normalize. In stressed markets, they stay elevated and they start to cluster. And notice what I'm not doing. I'm not handing you a target. I'm not telling you what to buy or sell. I'm showing you how to watch the system. If Tier 1 cools off, this story de-escalates. If Tier 1 stacks, you watch Tier 2 for alignment. And if you ever hear very specific claims about policy details or exact flows, treat them as unverified until credible sources confirm them. One final reminder. Narratives move fast. Data moves slower. In commodities, the market often tells the truth through premiums and timing before it tells the truth through headlines. That's why dealer repricing matters. It's the closest signal to replacement risk, and replacement risk is the first crack in the plumbing. This is not financial advice, just a framework for tracking what comes next. Over the next week, start with Tier 1, premium trend, lead time/no-quote behavior, and deliverable proxies. If you want updates as verifiable data comes in, and as these indicators either cool off or stack, subscribe. This story is about plumbing, and plumbing data updates in real time. Back in December 2025, the real story wasn't just a higher silver price. It was growing stress in the plumbing. Physical supply, delivery, settlement, and confidence. The key takeaway is simple. Price is just a number. What matters is whether the market can still deliver metal on normal terms. The practical lesson is to stick to the signals we listed, premiums, delivery times, and no-quote behavior, and always ask, is this confirmed, or is it still a sign that needs verification? When pressure builds at a choke point, the system doesn't always break with a bang, it slows down and then it clogs.